A storm is engulfing Volkswagen. The German auto titan that once symbolized engineering might is now skidding towards a financial cliff. So, how bad is it? Well, Volkswagen's own finance chief has issued an alarming ultimatum. He said that the company has a year, maybe 2 years, to turn things around. Now, this is not some tabloid prophecy, it's coming straight from VW's highest levels, and it underscores a crisis that few imagine possible. So, today on Drive Right Reviews, we're going to dive into Volkswagen's fight for survival. And it's a high stakes battle against collapsing profits, brutal competition, and the ticking clock of bankruptcy risk. So, buckle up, my friends, and let's dive straight in. So, let's start with the raw facts of VW's downfall. In 2024, the Volkswagen brand, the core of the group, saw its financial performance implode. Profit margins, once comfortable, well, they cratered to a shockingly low 0.9% in the second quarter of 2024, and that's according to Reuters. Now, that's essentially break even for a manufacturing giant. By comparison, rivals like Renault, well, they boasted margins of around 8 to 10%. VW went from making thousands of euros on every car to literally pocket change. Now, in the third quarter, things got even worse. Profits plunged 42% year on year to the lowest level in 3 years, again, according to Reuters. Now, this isn't a normal cyclical dip, it's a free fall. See, behind those grim earnings is a cash crisis. Volkswagen's automotive cash flow, that's a key gauge of financial health, well, it turned negative in the first half of 2024. So, the company that once printed money from cars like the Golf, well, they burned through it, and they burned through more cash than they generated, to the tune of €100 million outflow. Now, a year earlier, VW had a positive €2.5 billion in cash flow during the same period, but today it's underwater. Arno Antlitz, that's VW's CFO, he admitted the unthinkable. The Volkswagen brand has been spending more money than it earns for some time, and the company will not succeed if that trend continues. So, in other words, VW is living beyond its means, quarter after quarter, and that is a total recipe for ruin. Now, even sales can't save the day. Europe's car market is still in a post-pandemic slump, about 2 million vehicles smaller per year than before, and VW's unit sales, well, they've lagged far behind expectations. The company quietly slashed its 2024 sales forecast from growth to a slight decline. So, revenue is stagnating, costs are climbing, and profits are evaporating. VW's stock price reflects this bleak reality too. Their shares have lost a massive 44% of their value in the last 5 years alone, wiping out tens of billions in market worth. Once the world's second largest automaker, VW now looks like a giant in huge trouble, with investors and analysts openly wondering how much longer it can actually stay afloat. So, how did Volkswagen get here? Well, one major factor is an all-in gamble on electric vehicles, or EVs, and high tech, a gamble that's yet to pay off. VW committed to an eye-watering €180 billion investment, and that's over 5 years, to electrification and digitalization. So they poured money into battery factories, software, and new EV models. Now, that was supposed to secure VW's future against Tesla and their Chinese rivals, but instead, well, it became a double-edged sword. As CFO Antlitz put it, they're carrying a double burden, investing massively in the electric future while still having to keep traditional petrol cars competitive. So, in simple terms, VW is spending a fortune on tomorrow's technology without being able to stop spending on today's technology. Now, in all fairness, that strategy might work in the long run, but in the short term, well, it's punishing their finances. So consider this. The company's new software unit, Cariad, meant to revolutionize VW's car tech, lost 2.1 billion euros in 2022 alone. So developing affordable electric cars has proven slower and definitely more costly than they ever expected. VW has actually been late to the EV race, and when its electric models finally hit the market, well, demand did not explode as they hoped. In fact, EV sales in Europe have been far weaker than anyone predicted, especially after government/subsidies and Chinese automakers flooded the market with much cheaper models. VW's big bet on electric, and now it's stuck with massive R&D bills, new factories to pay for, and a consumer base that's not switching to EVs fast enough. It's absolutely a perfect storm. High expenses, slow returns. And all of this comes as their gasoline and diesel car sales are dropping off, meaning less cash to fund the EV transition. The result? Well, Volkswagen's grand EV ambition is squeezing its finances dry at the very worst possible time. Now, compounding the EV gamble is a simple, brutal truth. VW's cost structure is bleeding it dry. Building cars in Germany has become extremely expensive. Energy prices spiked, and German labor is among the costliest in the world. So for years, VW's home factories enjoyed generous contracts and guarantees. They promised no layoffs, and they haven't had layoffs since 1994. No plant closures ever in Germany's post-war history. But sadly, well, that era is long gone. Today, some VW plants are grossly underutilized, running at as low as 20 to 30% capacity in certain cases. Yet workers and overheads remain exactly the same. It's absolutely an unsustainable mismatch. VW's brand chief, Thomas Schaefer, even admitted that many German sites are 25 to 50% over cost target, some twice as expensive as competitor plants. So in plain English, VW is building cars at German factories that cost nearly double what it would in a more efficient plant elsewhere. Now, believe it, you don't need an MBA to see that this can't go on. Now, at the same time, unfortunately for VW, global competition has never been fiercer. China, VW's biggest market, has turned from a cash cow to a battleground. A decade ago, VW could count on fat profits from its Chinese joint ventures, but now those profits have been cut in half. Domestic Chinese brands like BYD, well, they're outpacing VW in the EV segment, and they're eyeing Europe next. Volkswagen's decade-old dominance is being challenged on all fronts by leaner, hungrier rivals who can definitely undercut their prices. So to keep up, VW resorted to steep price cuts on its own models. Not a good deal, only to find it slashed its margins to the bone, costing hundreds of millions of euros in lost profit. The logic of volume at any cost, it hugely backfired. Yes, they sold more cars perhaps, but each for far less profit. And as one analyst observed, this is one of the largest car producers in the world, which is not producing large returns. It's impossible to sustain. So, when a company as storied as VW starts doing the unthinkable, well, guess what? You know the crisis is real. In late 2024, VW's management dropped a huge bombshell. Excuse me, they're prepared to shut down at least 3 German factories and at the same time lay off tens of thousands of workers to stop the bleeding. Yes, VW is contemplating factory closures on its own home turf, and that will be for the first time in its 87-year-old history. The very notion is shocking. This is the company that practically invented the idea of the job secure German auto worker, yet here we are. VW has already terminated long-standing job security agreements with its unions to clear the way for layoffs that will start this year. It's a drastic about-face and it's born out of desperation. And the cost-cutting plan goes beyond headcount. VW is also demanding painful concessions from the workers who still remain. The company has asked them to take a 10% pay cut and agree to freeze wages this year and next year. It's essentially telling its workforce, accept less pay or there may be no more jobs left to save. Not surprisingly, that's triggered huge outrage. Now, at VW's Wolfsburg headquarters, thousands of workers gathered in protest. They blew horns and they waved banners vowing that not a single plant should shut. There's no doubt emotions are running high. Even VW's CEO, Oliver Bloom, admitted he felt emotional about potentially closing factories, but he also insisted it might be the only way to save billions in costs. Now, inside VW, a civil war of sorts has erupted between management and Labour. The powerful Works Council chief, Daniela Cavallo, publicly accused VW's top brass of betraying the company's legacy. Management is absolutely serious about all of this. This is not saber rattling, she said, indicating the threat is very real. She even described the plan as the start of the sell-off of Volkswagen's home country. Now, that's a scathing way to characterize closing German plants. The implications of political dynamite in Germany itself. See, VW isn't just a company, it's a national symbol and a major employer. Now, with layoffs looming, politicians are scrambling and unions are threatening strikes. VW's board members themselves sound alarmed. The situation is very serious, and without comprehensive measures to regain competitiveness, well, we won't be able to afford essential investments in the future. And that was admitted by VW executive Gunnar Killian. And it's a stark confession. If VW doesn't slash costs fast, it won't even have the cash to invest in new models or new technology. In other words, the company could enter a death spiral of decline. Layoffs, factory closures, begging workers for pay cuts, these are all emergency moves and the financial tourniquets to stop VW's bleeding. But will they be enough? Well, VW is now in a race against time. Do you remember that grave warning from the CFO? VW has maybe a year, maybe two to turn things round. Well, that was in late 2024, and the clock is ticking right now. If VW cannot restore profitability to its core business by 2025 or 26 at the latest, well, it risks something once unthinkable, running out of money. Now, think about it. A company of VW's scale has enormous fixed costs. If they're not making money on cars, they burn cash at a prodigious rate. Yes, VW still has some buffers, like Audi and Porsche, who have been propping up results with higher margin luxury sales. But the VW brand itself, well, that accounts for over half of group production, and its collapse would drag the entire empire down. Now, already, we've seen VW Group cut its profit outlook and net cash flow targets because the VW brand underperformed. The fear is palpable. One headline dubbed VW a too big to fail German mess. Now, critics argue that VW might even need government support if things worsen. A bailout for Germany's flagship automakers. Now, it wouldn't be the first time a car giant needs saving, but for VW, pride of the nation, it will be a huge fall from grace. Now, on the other hand, some do believe that VW can and will pull through, albeit by reinventing itself in the process. The company isn't sitting idle, though. It's reallocating investments, and it's potentially delaying some of that EV spending spree to conserve cash. It's also trying to boost efficiency in every way possible, essentially in a full survival mode. So the next few quarters will be very critical. VW has to prove it can still stop the cash bleed, even as it funds new electric models that are its best hope for future growth. It's kind of like repairing an airplane in mid-flight. It's incredibly challenging, but it's not impossible with the right leadership and a huge amount of luck. So VW's story has reached a dramatic crossroads. Will this 86-year-old icon of industry manage to steer out of its skid, or are we witnessing the slow-motion crash of a giant? The stakes really couldn't be higher. If they succeed in their turnaround, it will emerge a leaner, more innovative force, and that will be a testament to German engineering resilience. But if it fails, well, the fallout could rattle the entire auto industry and at the same time devastate Germany's economy. So let's keep our fingers crossed that they do manage to get out of this fall. And in the meantime, guys, I'll keep you posted and I'll see you on the next one.